Hey, what's up, you guys? Welcome to another video. And today, let's talk about interest rate and how it will affect the market. So here we have a piece of news that just came in from the FOMC Federal Reserve meeting that signals interest rates will stay higher for longer. The US Central Bank says there has been a lack of further progress towards 2% inflation goal. And I believe the data came in um, around 5% for the inflation as of now. Um, and the Federal Reserve was hoping that the interest rate will steadily decline because of the high interest rate, but it didn't happen. So right now, they are canceling the interest rate cuts that they scheduled for this year. And a lot of the sell off recently is because of this factor. Jay Powell said it's likely to take longer for us to gain confidence that we're on a sustainable path down to 2% inflation. That means the inflation is more sticky than what the Federal Reserve had expected. The Federal Reserve has signaled that the US borrowing costs are likely to remain higher for longer as it wrestles with persistent inflation across the world. The Federal Open Market Committee said after its meeting on Wednesday that there had been a lack of further progress towards its 2% inflation goal, a language that implies rate cuts will be delayed until the second half of the year at the earliest. So remember, they said the interest rate will be delayed until the second half of this year, but that might not happen if interest rate stays high. If the inflation rate stays high, there's a very high likelihood that there won't be any rate cut this year. And it won't be pretty for the stock market and crypto market. Remember, they're all connected. So high interest rate will lower asset price across the board, no matter if it's real estate or stocks or crypto, and low interest rate will prop their prices higher. Jay Powell said, it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. And he said he doesn't know how long it will take. But the Fed also indicated that it was not yet considering new rate rises to counter the recent uptick in inflation, saying that the risks to meeting its joint goals of full employment and subdued price pressures had moved towards better balance over the past year. So here they said they're not going to raise interest rates. A lot of the worry recently, especially from the traders, are that the Federal Reserve are going to raise interest rate. If that happens, that's going to put downward pressure over global markets, especially the stock market. And that would cause the stock prices to fall. But here they indicate that they will not raise interest rate. So that's like one piece of good news in a plethora of bad news. He said it's unlikely the next policy rate move will be a hike. So they're not going to hike interest rates. They're not going to lower interest rate. What's likely going to happen is that they're going to keep interest rate as it is. The US Central Bank held interest rate at 5.25% to 5.5%, a 23-year high that has been in place since the summer of 2023. The higher for longer rate signal from the Fed follows recent data showing that inflation had crept higher again, largely driven by costlier fuel, while the US economy grew more slowly in the first quarter of the year than expected. The comments from the Fed also means that borrowing costs could remain higher for many US voters in the run-up to this year's presidential election in November. Joe Biden said recently that he expected those rates to come down this year. Yeah, another thing is that the US president would want the rate to be lower because this year is election year and they want the rate lower so the stocks and other assets will move higher. It's good for their presidential campaign. You know, if the stock market is going down and there's an election going on, it's not a good thing for the current president. They want the economy to be good and people are making money when that's more likely that they will be re-elected. So Joe Biden most likely wants to cut rates, but the Federal Reserve does not see a reason to do so. The Fed's room for maneuver has shrunk drastically, with inflation ticking up, growth slowing, and the political calendar becoming an increasingly tight constraint, said a professor at Cornell University. The spectrum of stagflation, which the Fed seemed to have decisively put behind it in 2023, is now back in the picture. Powell pushed back against that prognosis of 1970s-style inflation coupled with stagnation in the economy, saying growth remained strong and price pressures were under 3%. He said he doesn't see the stagflation. The Fed also announced that from June it would reduce the cap on the amount of US Treasury bonds it allows to mature each month without buying them back from 60 billion to 25 billion. It will still allow up to 35 billion in mortgage-backed securities to roll off the balance sheet. Any principal payments in excess of the 35 billion cap would also be reinvested in treasuries. In a market where some treasury auctions are currently at record sizes, the slowdown in quantitative tightening could help bolster prices and lower yields. US rate setters had hoped to cut interest rates 3 times this year, but higher than expected inflation in recent months has raised the prospect that the Fed would keep the borrowing cost at current levels for the duration of 2024. Okay, so now the expectation has been set that there likely won't be any rate cuts this year. And here are some commentaries from other economists. Yeah, there you have it. This is the latest news on the Federal Reserve and the interest rate. I hope you enjoyed it. Don't forget to comment below and like the video, subscribe to the channel, and we'll see you next time.